If you ever ran a business or ever thought about starting one, you probably heard that taxes can get complicated very fast. But most people don't actually understand how small business taxes work. So, this guide helps you understand how money flows through a business, which parts are taxed, and why write offs and deductions actually matter. Hi, my name is Keran, and I own multiple seven-figure businesses and help business owners understand and save on taxes at keepmost.com. And by the end of this video, you will understand how small business taxes work from start to finish. Starting with why business taxes exist in the first place. You see, every country collects taxes to pay for things we all use: roads, schools, healthcare, and public safety. In the United States, taxes fund local, state, and federal government services. And when it comes to business, the idea is quite simple. If you earn money from running a business, a portion of that income goes back to the government through taxes. But unlike a regular job where your employer automatically withholds taxes from your paycheck, business owners are responsible for calculating, collecting, and paying their taxes all on their own. And that's where it gets tricky. So, understanding how it all fits together helps you stay compliant and, more importantly, avoid paying more than you have to. Let's look at exactly what kind of taxes businesses pay and how they work. Business taxes are not just one single tax, they're a mix of different kinds of taxes depending on what your business does, where you operate, and how your business is structured. And here are the main types that you will come across. The first is income tax. And this is the big one. You pay income tax on the profits your business makes, aka what's left after you subtract your expenses from your revenue. For example, if your business makes $100,000 in revenue and spends $40,000 in expenses, you pay income tax on $60,000. Now, depending on your business structure, which we'll cover pretty soon here, that income might be taxed on your personal tax return or at the business level. Next is self-employment tax. If you work for yourself, you don't get a paycheck with Social Security and Medicare taxes automatically withheld. So, you pay them directly through something called self-employment taxes. And currently, the self-employment tax rate is about 15.3%. It covers a couple of things: 12.4% of it for Social Security and 2.9% for Medicare. So if you earn $100,000 in business income, around $15,300 of that goes towards self-employment taxes before you even pay income tax. Next, we have payroll taxes. If you have employees, you must withhold and pay taxes on their behalf. This includes federal income tax withholding, Social Security and Medicare taxes, and state income tax withholding if it applies to you. You also pay the employer's share of Social Security and Medicare, plus unemployment taxes. Even if you hire just one employee, this becomes part of your responsibility as a business owner. And then there's sales tax. If you sell goods or taxable services, you may have to collect sales tax from customers and send it to your state or local tax authority. This isn't money that belongs to you. It's money you collect on behalf of the government. For example, if you sell a product for $100 and your state sales tax is 8%, you collect $108 total. Keep the 100, but you remit the $8 back to the state. Failing to handle sales tax properly is one of the most common mistakes small business owners make. And then we have what I call other taxes or miscellaneous taxes. You see, depending on your location or industry, you may also owe franchise tax for doing business in certain states, excise tax for specific goods like fuel, alcohol, or tobacco, and even property taxes if you own business property. Now, not every business owes these, but it's worth knowing they exist. And now that you know the main types of taxes, the next big factor is how your business structure affects the way those taxes are applied. One of the most important factors is how businesses is taxed is your business structure. Different types of businesses are treated differently by the IRS. So let's look at the most common one. And we'll start with the sole proprietorship. If you're a freelancer or single owner business without a formal structure, you're considered a sole proprietor. And with this business structure, you and your business are considered the same entity. All profits pass through to your personal tax return, and you pay income tax and self-employment tax on that income. It's a very simple structure, but not always the most tax efficient structure as you grow. Then we have the partnership. If you run a business with one or more partners, it's likely a partnership. Now, in this structure, the business itself doesn't pay taxes. Instead, each partner reports their share of the profits on their personal tax return. Now, you'll still deal with self-employment taxes, but you can also split profits and deductions between partners. Then we have the fan favorite limited liability company, also known as the LLC. An LLC is flexible. By default, a single member LLC is taxed like a sole proprietorship, and a multi-member LLC is taxed like a partnership. However, an LLC can also choose to be taxed as an S corporation or a C corporation, depending on what's most beneficial. And that flexibility is why LLCs are so popular among small business owners. So let's talk about the S corporation, also known as the S-corp. An S-corp is a special election that allows profits to pass through to owners without being taxed at the corporate level. The biggest advantage is that you can pay yourself a reasonable salary and take the rest of your profit as distributions, which are not subject to self-employment tax. This often saves money for business owners who earn consistent profits. And I wouldn't recommend this unless you make $60,000 in net profit consistently. And then we have the C corporation, also known as the C-Corp. A C-Corp is a separate legal entity that pays its own taxes. Now, the downside of a C-Corp is double taxation, where the company pays taxes on profits and shareholders pay taxes again on dividends. However, C-Corps can reinvest profits, access more deductions, and offer stock options, making them better for larger businesses or startups who reinvest heavily. And once you know your structure, it's easier to see how money actually flows through your business and where taxes come into play. Let's walk through taxes next by looking at the journey of a business dollar. Let's trace how a single dollar flows through your business. First, you earn revenue. This is all of the money your business brings in from sales or services. Next, you pay expenses like rent, supplies, software, marketing, payroll. All of these reduce your taxable income. Then you calculate profit, which is also called net income. Revenue minus expenses equals your profit. Once that's complete, you apply deductions and credits. Deductions and tax credits reduce how much taxes you actually owe. Lastly, you pay taxes on what's left. That's it in simple terms. So, as an example, let's say you make $100,000 in sales. You spend $40,000 on expenses, you earn $60,000 in profit. That $60,000 is your taxable income. Now, depending on your structure, it may be taxed as personal income, business income, or both. Now, let's dive into deductions and credits so you know how to lower your tax bill. You've probably heard business owners brag about all the things that they write off. Here's what that actually means. A deduction is something that reduces your taxable income. So, for example, if your taxable income is $60,000 and you have $10,000 in deductible expenses, you'll only pay taxes on $50,000. And common deductions include office rent or use of your home office, business travel, equipment and software, marketing costs, vehicle expenses, professional services like accountants or lawyers. But the key is that the expense must be ordinary and necessary for running your business. Now, a credit is something that directly reduces your tax bill. If you owe $10,000 in taxes and qualify for a $2,000 tax credit, you now only owe $8,000 in taxes. Now, credits are more powerful than deductions because they reduce what you owe dollar for dollar. Some popular tax credits include hiring certain employees, where you get the work opportunity credit, investing in research and development, which is known as the R&D credit, and energy efficient upgrades, even though a lot of those are going away at the end of 2025. I know of about 80 plus credits and deductions that can help you save on taxes, and you can find them at keepmost.com. Another big thing that helps reduce taxes is something called depreciation. Things like equipment, buildings, or vehicles lose value over time. And in general, with depreciation, you spread that deduction over several years. That's through depreciation. This reflects how assets gradually wear out and helps match your tax deductions to how long you use the item. Now, bonus depreciation is back, which allows you to deduct up to 100% or depreciate up to 100% of the cost of that item in the first year. Very powerful. Now, something I have to cover is the fact that a write-off doesn't mean free money. If you spend $100 on office supplies and you're in the 20% tax bracket, your taxes go down by $20, not by $100. You see, you still spent $100, you just get to reduce your taxable income slightly because of it. And that's important to note because you don't want to go out and spend unnecessarily for the sake of a write-off, because you're spending more money than you saved. And with all of this tax talk, you might be asking yourself, when and how do you actually pay those taxes? Your business taxes aren't paid all at once at the end of the year. Most businesses pay as they go, starting with the first requirement, which is quarterly estimated taxes. If you expect to owe more than $1,000 in taxes for the year, the IRS requires you to pay estimated taxes 4 times a year, in April, June, September, and January. Now, these payments cover both your income tax and self-employment tax. If you don't pay enough throughout the year, you may owe penalties even if you pay the full amount at the end of the year. Then there's your annual tax return. Every business must file an annual return summarizing your income, expenses, and taxes owed or already paid. Even if you file quarterly, you still file one return for the full year. Then there's payroll taxes, because if you have employees, you must regularly deposit payroll taxes, often every 2 weeks or monthly. These go to both federal and state government. This includes withholding from employee paychecks and the employer share of Social Security and Medicare. Then there's sales taxes. Sales taxes are collected when you make sales and must be sent to your state on a set schedule, monthly, quarterly, or annually, depending on your volume. It's important to separate this money from your business funds since it technically belongs to the government. Now, paying taxes is one part, but keeping the right documentation is what protects you if the IRS ever comes knocking. So let's cover that. You see, the IRS can audit you for up to 3 years after filing, sometimes even longer. So keeping detailed records protects you and helps you claim every deduction you deserve. So you should keep the following things: receipts and invoices, bank statements, mileage logs if you deduct vehicle expenses, payroll and contractor payments, and prior tax returns. I recommend keeping records for at least 3 to 7 years. And modern accounting software like QuickBooks or Wave make this much easier by automatically tracking and categorizing your transactions. Still, even with great records, many new business owners slip up. So let's go over the most common mistakes to avoid. The first mistake is mixing personal and business expenses. Always, and I mean always, use a separate bank account and credit card for your business. Mixing funds makes bookkeeping a nightmare and can cause legal issues. Next, we have ignoring quarterly taxes. If you only pay at the year end, you'll likely owe penalties. Another mistake is misclassifying workers. Calling employees contractors to save on payroll taxes can lead to major IRS fines. Then we have a big one, which is forgetting about state and local taxes. Every state has its own rules for income, sales, and franchise taxes. Don't assume federal rules are the only ones that matter. Mistake number 5 is not tracking deductions. You can't claim what you don't track. Missing even small, reoccurring expenses can add up fast. If any of these mistakes sound familiar or you just want peace of mind, I recommend hiring a professional. Because even if you understand how taxes work, it doesn't mean you should handle everything alone. So there are four main types of tax professionals. The first is your bookkeeper. They handle the day-to-day tracking and reporting. Next, you have CPAs, which is a certified public accountant. They prepare and review tax returns. You also have enrolled agents, also called EAs. They're federally authorized to represent you before the IRS. And lastly, you have tax strategists who help you to plan and save on taxes. That's what I am and what we do at keepmost.com. You see, hiring a professional helps you to stay compliant with changing laws, identify deductions and credits that you might miss, and also save time and reduce stress. It's often cheaper to pay a good tax strategist than to make costly mistakes yourself. So putting it all together, here's what it all comes down to. You earn revenue, you spend money running your business, you calculate your profit, you pay taxes on that profit, and you keep records to prove everything. That's it. That's the entire small business tax system in a nutshell. So don't wait until tax time to think about taxes. Learn the rules, track your numbers, and use them to your advantage. If you want to know every way to reduce your taxes, eliminate your taxes, or shift your taxes, head over to keepmost.com. Let me know if you have any questions in the comments. And with that said, my name is Keran, and I'll see you in the next video.